China today warned the United States against attempting a technical debt default to force further spending cuts in the U.S. The idea of a technical default, essentially delaying interest payments for a few weeks, is gaining popularity with the Republicans. Beijing, which incidentally is the largest holder of U.S. assets, says any such move will destabilize global growth, and it has said that the U.S. is playing with fire. That's the exact comment made by a Chinese official. Analysts, of course, believe such a move will have disastrous consequences, sending the world back into recession. The U.S. deficit will touch $1.4 trillion this year, and the Treasury will run out of borrowing money by the 2nd of August. The Republicans and Democrats are yet to reach an agreement on raising the debt ceiling. All right, over to New York then, where we've got Ed Rombach, who's a markets analyst with Thomson Reuters, who he joins us on the show with his perspective on this story. Now, Republicans in the U.S. are discussing a technical debt default that would then effectively force the White House to accept deeper spending cuts. But what would you believe the impact of such an action could essentially be on global markets?
Well, it's a great question. I think talk of a technical default or default in U.S. debt is nonsense, and solvency is really not the issue, because the U.S. can issue debt in its own currency, which it can print in unlimited supply. The real problem is that if you overprint the money, you get inflation, and which some would call default by another name. That's what's shaping up. I believe there's going to be a deal to arrive at a solution to the debt ceiling before we have a problem, and I think the markets believe that too. Otherwise, a 10-year Treasury note wouldn't be trading below 3% yield, and U.S. sovereign credit default swap protection would be soaring, which it isn't.
Right, Ed, but looking at this a little differently, should one read this as the arrogance of a country that firmly believes that even if it opted for a technical default, world markets will have little option but to continue to subscribe to U.S. Treasury sales?
Well, it's another great question, because, see, that's the benefit of having the reserve currency. See, the rest of the world sends America goods and products that they can't afford to consume themselves. In exchange, we give fiat currency, which really has no intrinsic value. And as President Nixon's Treasury Secretary John Connally once put it, the dollar, it might be our dollar, but it's your problem.
Right, Ed, and separately, China has actually come out and said that the U.S. is playing with fire, to quote a senior Chinese government official. Now, considering that China has 2/3 of its foreign currency assets parked in U.S. Treasuries, does this have the potential of snowballing into a political standoff between the two countries? That is, should the U.S. actually resort to a technical default?
Well, there's a lot of saber rattling, probably, within Congress and within China, saying that we're playing with fire. But I believe a deal is in the making, if not already made. And that deal is that there will be no QE3. And the idea here is to avoid putting further selling pressure on the dollar.